Today's topic is going to be on, are you missing out on tax-free monies? Many of you are, and that's a problem, it's a shame, and we want it to stop right now because we want to show you how you can and should build more tax-free money. Well, first, let's begin by talking about the tax situation in America. Did you know that our budget for our country is $6 trillion? And that $3 of the $6 trillion comes from income taxes that you and I pay every single year. So $3 trillion goes to income taxes. But there is a problem, folks. The problem is this: 40% of U.S. households pay no income taxes at all. What does that mean to you? It means that if you are a taxpayer, you're among the 60% that are actually paying all of the $3 million burden. Now, there were some tax changes that were made that benefited most Americans back in 2017, and those are scheduled to be done. Those tax benefits that we're enjoying are going to be finished in about a year and a half. December the 31st of 2025, they are scheduled, if no other changes are made, to go back to higher taxes, less benefits to us, standard deductions are going back down, and that means that you're going to pay more of that amount of money that is owed. So that's a problem. And the way that most of us are saving for retirement, we're saving in monies that's going to be the most taxable in retirement. So think of it this way. Here's how most people, we're going to call them Sam or Sally, are saving for retirement. So let's say they're in their working years and Sam or Sally invest $10,000 per year into their 401k or retirement plan at work. And because that's a tax deferred account and they don't pay taxes now, they actually get a tax benefit. If they're in a 30% tax bracket, $10,000 goes in, and that's a $3,000 savings to them. Well, that's great. $3,000 saved. Well, if they do this for 30 years, $10,000 times 30 years, that means that they put in $300,000, and over that 30-year period, they enjoyed a great tax benefit of a savings of $90,000. That's not a small amount of money. So now let's say that they're 60 years old, they're getting close to retirement age, but they're not retired yet. And that account, because of the growth of the stock market over 3 decades now, that $10,000 per year for 30 years over the 30-year period has grown now to $850,000. Yay, that's a great amount of money, $850,000. But they've paid no taxes on it. Let's say, for instance, that they don't need the money right now. They're going to work a little bit longer and they don't need it, so they let it continue to build. By the time they're 73 and required minimum distributions are due to be taken out of that from age 73 for the rest of their life, every year they have to pull that out. Well, because the money of $850,000 grew to $1.9 million tax deferred between the ages of 60 and 73, they now have, get this, drum roll, $1.9 million in that account. Folks, that is not a small 401k. That's not a small amount of money saved up for retirement. So now they have to pull monies out. Let's say they only need $40,000. Well, that's not enough. You see, based on their age, the government makes them pull out $70,000 whether they need it or not. So they pull out $70,000, and let's say that by then their tax bracket has grown and now they're only paying 25% in taxes. They pull out $70,000, 25% of it goes to the IRS, they get to keep the other 75%. Well, the 25% that goes to the IRS is $17,500. Remember that figure. $17,500 goes to the IRS, and then they keep the difference out of the $70,000. If they do that for the next 6 years, 6 times 17,500 is $106,000. They've now, in the first 6 years that they're withdrawing money for retirement, they've now paid out $106,000 in taxes. Now, what did they save in taxes over their working career of 30 years? Remember that number? $90,000. So they saved $90,000, and now in a short amount of time, they've already paid $106,000 in taxes, and the remaining balance of that 401k or retirement plan is taxable forever. To them, if they live to be 80, 85, 90, 95 years old, every time they pull money out, they have to pay taxes. And when they die, their beneficiary, let's say they have a spouse, they have to now withdraw money and they pay taxes on the money they withdraw. And then if it's left to their children as beneficiaries, they have to pull all that money out over a 10-year period, and they have to pay taxes every year that they pull the money out. So the tax burden is great. Why? Because tax deferred sounds awfully good when we're in our working years, but when we're in our retirement years, we're paying a lot of money in taxes at the worst possible time when we need all of that money for ourselves. We've got to share a greater amount of that with the IRS. Why? Because most people are saving money in taxed later money. Now, let me ask you a question. An IRS agent walks onto a farmer's property and asks the farmer, "Mr. Farmer, you have a choice. You can either pay taxes on your seeds that you're planting in the ground, or I'll come back later and you can pay taxes on the harvest when it is grown later in the fall." What do you think the farmer is going to say? The farmer is going to say, "Well, it seems like it would be a lot less in taxes if I pay the taxes on the seed first, and then when the harvest is great, it's all tax-free." That sounds beautiful, but that's the opposite of how most of us are saving for retirement. And so there's 3 buckets of money that most people in retirement have. 3 different kinds of money taxed in different ways. These 3 buckets, well, 2 buckets and this little cup, we'll call it a solo cup, is representative of different taxes that can be on your money. Now, this bucket is a big bucket. This one is kind of a medium size, and this is very small. So let's turn those buckets around, because there are 3 kinds of taxed money that you have. Taxed later money, taxed always money, and taxed never money. Taxed never money, did you get that? So, if it's taxed never money, would you rather it be in this bucket? Tax never, that's tax-free. Or maybe this bucket, or this one. Well, let me show you how most people in America save, and then when they retire, if they have money in those 3 categories, let me show you representative kind of how that works. Most people, their biggest bucket of money is taxed later. Well, when is later? It's in retirement. And the most amount of money that they've saved for retirement is going to be taxed then for the rest of their lives. Then the next smallest or biggest bucket is the taxed always bucket. Now, whereas this money is your 401k, your IRA, your 403b, your retirement monies, your pension monies for retirement, the taxed later money. The taxed always money is more like your CDs at a bank, a brokerage account that you have with mutual funds and so on, that's not a retirement account, but you have to pay tax every year as you make money. You get a 1099. You know what that is, don't you? You get that, you got to prepare your taxes, that 1099 becomes important because now that's taxable income. That's the second biggest account that most people have saved for retirement. And the third is the tax never bucket. That's the tax-free bucket. And that tends to be the smallest amount of money that people have. So let me just put numbers to these. An example of a typical retired person today, they may have $800,000 in this bucket. They may have $300,000 in the middle bucket, and they may have $50,000 in this bucket, tax-free. If they could change those buckets around, and this could become the tax-free bucket, and this could become the tax later bucket in retirement, they would be much happier with that. There are things that you can do. There are steps that you can take no matter what age to begin to build your savings for retirement so the biggest bucket that you have to draw from can be tax-free. You're missing out on tax-free money. And our job as advisors is to help you begin to change the buckets around and put more and more money in the tax never or tax-free bucket. We'd love to be able to help you with that. If you'd like to learn more about it, you can contact our office in the link below. And of course, subscribe to our channel to learn more about strategies just like this to benefit you and your family.